Welcome to my channel. uh, Today we are talking about next ratio, capital structure ratio. As we have discussed about our previous class about liquidity ratio, you can go through it. Now today part 2 of ratio analysis. Now second ratio, that is capital structure ratio, or leverage ratio, or long-term solvency ratio. Now let's start. Capital structure ratio. Capital structure ratio, or leverage, or long-term solvency ratio. Long-term solvency ratio are financial ratio that measures a company's ability to meet its long-term obligations. This ratio provides information about a company's financial health, risks, and stability in the long term. Long-term creditors are more interested on this ratio. Long-term creditors are more interested on this ratio. They want to know whether the company is able to pay interest when due and the principal at maturity. They want to know whether the company is able to pay interest, when due and principal at the maturity. Now we are going to discuss about the capital structure ratios, what includes in the capital structure ratio. Now first, equity ratio. The equity ratio is a financial ratio that measures the proportion of a company's asset that are financed by shareholders' equity. Equity ratio is a financial ratio that measures the proportion of a company's asset that are financed by its shareholders' equity. The equity ratio provides an indication of how much a company's assets are owned outright. Outright means wholly or partially or completely by its shareholder. The equity ratio provides an indication of how much of a company's assets are owned outright by its shareholder. A high equity ratio indicates that a company has a relatively low amount of debt. High equity ratio indicates that the company has a relatively low amount of debt compared to its asset, which may be viewed as a positive signal for financial strength and stability. So, what we can conclude that high equity ratio indicates that the company has a relatively low amount of debt compared to its asset, which can be viewed as a positive signal. On the other hand, a low equity ratio indicates that a company has a high amount of debt. This means low equity indicates that company has a high amount of debt compared to its assets, which may be viewed as a negative signal of financial risk and potential instability. Now, in short, equity ratio is a measure of how much a company's assets are funded by shareholders rather than the debt. It shows the proportion of the total asset of the company that belongs to shareholder and not to creditors or lender. Now we take one of the examples. For example, if a company has rupees 100 in asset and rupees 40 is financed by shareholder equity, the equity ratio would be 0.4 or 40%. That means 40% of the company's assets are funded by shareholders and the remaining 60% are funded through debt or other liabilities. Now we are going to discuss about a formula. What formula indicates? Equity ratio means what's the formula of equity ratio? Means equity shareholders fund divided by capital employed. Equity shareholders fund can also be said as net worth, net worth, proprietary fund, or owners equity. Equity shareholders fund can also be termed as these three, means net worth or proprietary fund or owners equity. Now, what does equity shareholders fund includes? Equity shareholders fund includes paid of equity share capital, reserve and surplus, excluding revaluation reserve, most important, miscellaneous expenditure. We have to deduct miscellaneous expenditure. What does miscellaneous expenditure means? Miscellaneous expenditure means expense that not directly related to core business operation of the business. Miscellaneous expenditure are those expense that are not directly related to core business operations, core operation of the business. Now we deduct fixed asset, P&L debit, and calls in error from to calculate the equity shareholders fund. Now we revise shortly. What does equity shareholders fund includes? Paid of equity share capital, reserve and surplus to add, miscellaneous expenditure to deduct, fixed asset to deduct, P&L debit to deduct, and calls in error to deduct. Similarly, reserve and surplus. What reserve and surplus can include? Reserve and surplus also include where reserve and surplus include general reserve, P&L credit, investment allowances, securities premium, return earning, capital subsidy from government, CRR and DRR. Reserve and surplus include these items. Okay. Similarly, now we are discussing about equity ratio, equity shareholders fund divided by capital employed. We have discussed about what includes in equity shareholders fund and what includes in reserve and surplus. Now similarly, what includes in capital employed? We are going to discuss now. Capital employed includes paid of equity share capital, reserve and surplus, including revaluation reserve. Most important, revaluation reserve means non-distributable reserve, that is same as retained earning. While calculating equity shareholders fund, we are excluding revaluation reserve from the reserve and surplus while calculating equity shareholders fund, but while calculating capital employed, we have to include revaluation reserve. We have to include revaluation reserve. We have to include revaluation reserve. Okay. Reserve and surplus plus preference share plus preference share capital, secured and unsecured long-term loan. What does secured and unsecured loan means? In secured loan, we have to make that collateral within the company, and in unsecured loan, long-term loan, we are not given towards the collateral. We will not take the collateral of that loan while borrowing the loan, and we have to deduct P&L debit, we have to deduct miscellaneous expenditure, we have to deduct fixed asset. What is fixed asset means? Fixed asset means a preliminary expense such as preliminary expense, underwriting commissions, loss on issue of securities. Fixed asset means preliminary expense, underwriting commissions, loan on issue of securities. What is, and we deduct non-trade asset. What does non-trade asset represents? Means non-trade assets are those assets which remains idle in the business and do not give benefit, like investment in securities, PPE, plant property and equipment, and other intangible assets. So While summarizing the capital employed, we will take paid of equity share capital, reserve and surplus, including revaluation reserve, preference share capital, secured and unsecured long-term loans. Now we deduct P&L debit, deduct miscellaneous expenditure, deduct fixed assets, and deduct non-trade assets. This was all of the equity ratio. Now, second, we will discuss about what is debt ratio. Debt ratio. The debt ratio is a financial ratio that compares a company's total debt to its total asset. Simple. The ratio measures the percentage of a company's asset that are financed by debt. For example, if a company has rupees 5 lakh in total debt and rupees 10 lakh in total asset, the debt ratio would be total debt divided by total asset. That means 50%. What this means that 50% of the company's asset are financed by debt. Simple. The debt ratio is important measure of a company's financial leverage and risks. A high debt ratio indicates that a company is more heavily reliant on debt. Reliance means dependent on debt to finance its operation. This can be risky as the company will have to make a regular debt payment, which can be a burden if the company experience a decline in revenue and or earnings. One time again, this can be risky. What can be risky? High debt ratio can be risky because the company will have to make a regular debt payment, interest payment, which can be a burden if the company experience a decline in revenue or earnings. On the other hand, low debt ratio indicates that a company is less reliant, less dependent on debt financing, and a lower risk of defaulting on its debt obligations. However, a very low debt ratio may indicate that the company is not taking advantage of financing opportunities that could potentially enhance its growth and profitability. Now we are going to discuss about what is the debt ratio formula. Means debt divided by capital employed. Debt means always long-term debt. Debt means long-term debt. This was debt ratio. It's simple, okay? You go through it one time. Now third point, debt equity ratio. Most important, debt equity ratio. Debt equity ratio or debt to equity ratio is a financial ratio that measures the proportion of debt and equity a company is using to finance its asset. Debt equity ratio indicates the degree to which a company is using debt to finance its operation and investment, and how much of the company is financed by its shareholder. It is a measure of financial leverage that shows how much a company's assets are funded by debt and how much by equity. Standard ratio is 2:1. This means debt equity ratio indicates the degree to which a company is using debt to finance its operation and how much company is financed by its shareholder. The standard ratio is 2:1. High debt equity ratio may indicate that a company has taken on a debt relative to its equity. High debt equity ratio indicates that company has taken on a lot of debt relative to its equity, which can be risky because it means the company has a lot of interest payment to make and may have a difficulty meeting its debt obligations if they experience financial difficulties. On the other hand, a low debt to equity ratio may indicate that company is conservatively financed and has less financial risks. In short, lower the ratio, better it is for the long-term lenders because they are more secure in that case. A high debt equity is danger signal for the long-term lenders. This point is very much important. Lower ratio is better because it is for the long-term lenders because they are more secure on that case. If lower debt equity ratio is if debt equity ratio is lower, high debt equity is danger signal for the long-term lenders because they have to give more interest payment to the lenders. Shareholders want a high debt equity ratio to get a leverage advantage, but in the point of shareholders wants high debt equity ratio. What's the formula of debt equity ratio? Very much important. Debt equity ratio formula: long-term debt divided by shareholders fund or net worth. Long-term debt divided by shareholders fund or net worth. Long-term debt means secured or unsecured, or shareholders fund means shareholders fund or net worth, but it includes preference share also. In calculating the debt equity ratio, we have to include the preference share in shareholders fund because they are also the part of this equity share, they are also the part of shareholder preference share. So we are including shareholders fund or net worth for preference share also. You have to know about this. Or outsider long-term debt divided by insider long-term fund includes preference share, or debt divided by net worth, or debt divided by proprietors fund, where debt net worth represents total asset minus external liabilities. What is external liabilities? External liabilities means something payable to third party or other parties or organizations. Means external liability means trade payable, loan payable, bond payable to outsiders. That is obligations or debt owned by a company to the parties outside the organization is external liability. We have to deduct from total assets to calculate net worth. I think you have understood about debt equity ratio. Now move forward. Next point, fixed asset ratio or fixed asset to long-term fund ratio. Fixed asset ratio or fixed asset to long-term fund ratio. Important. Fixed asset ratio, the formula is fixed asset divided by capital employed. Higher fixed ratio indicates that a larger proportion of a company's assets are invested in fixed asset, while a lower indicates that a smaller proportion of the assets are invested in fixed asset. So simple. Fixed asset divided by capital employed. Now we discuss about next debt to total asset ratio. This is also very much important ratio. Debt to total asset ratio. Debt to total asset ratio is a financial ratio that measures the proportion of a company's asset that are financed by debt. Total asset, okay, the total assets that are financed with debt. Debt to asset ratio means debt divided by total asset. Debt means total outsider liability. Debt divided by total assets. Now, what does it indicates? A higher debt to total asset ratio indicates that a larger proportion of a company's assets are financed with debt, which may indicate a higher degree of financial leverage. On the other hand, lower ratio suggests that a company is less reliant, means dependent on the debt financing, and maybe stronger financial position. Debt to total ratio is commonly used by investor and analyst to evaluate a company's financial risks to access its ability to meet its obligation. Generally, higher higher ratio is considered a higher risk because it suggests that the company may have more difficulty in meeting its debt obligation in the event of economic downturn and financial hardship. Now we have discussed about the total assets. We have discussed about the total assets. Then what does it includes? What does it includes in total assets? Debt divided by total assets. Total asset in excludes. Okay, excludes. What does total asset excludes? Total asset excludes miscellaneous expenditure, fixed asset, P&L debit, preliminary expense, and intangible assets like goodwill and trademark. Okay. Now one of the most important ratio, proprietary ratio. The proprietary ratio is a financial ratio that shows how much a company's assets are financed by shareholders equity. How much company's assets are financed by shareholders equity. Proprietary ratio formula: net worth or shareholders fund or proprietors fund divided by total assets. And total assets is earlier means total asset, as we have discussed in previous point, total assets excludes these all 5 points if in the questions. Now what is formula means? Net worth or total shareholders fund or proprietary fund divided by total assets. What does it indicate now? Higher proprietary ratio means that more the company's assets are funded by its shareholder, which is generally considered a good things because it indicates the company has a strong financial foundation. Higher proprietary means that the company's assets are funded by shareholders, which is generally considered a good things. Okay. On the other hand, a lower ratio means that the more of the company's assets are financed by debt, which can be risks because the company may have a difficulty in paying off its debt in the coming future. The proprietary ratio is commonly used by investors and analysts to evaluate a company's financial risks and to access the long-term financial stability. A higher ratio generally viewed as a positive because it indicates that a company has a strong financial foundation and is less likely to face financial difficulties. This was about the proprietary ratio. Please note it down if you required. Now another important ratio is capital gearing ratio, or it is also known as gearing ratio. We discuss about the formula. Capital gearing ratio means fixed claim bearing fund divided by equity shareholders capital, or in short form we can also include that formula uh, about fixed rate divided by non-fixed rate. Means what are the fixed rate that we will get while investing? Means in long term debt we can get the fixed interest rate. For preference share capital we can get the fixed preference capital, but we are not going to get the fixed interest rate towards the equity share capital. So the formula means fixed claim bearing fund divided by equity shareholders fund, means long term debt plus preference share capital divided by equity shareholders fund. Now what does it include? What does it indicate? A higher capital gearing ratio indicates that a larger proportion of a company operation are financed through debt, which can be more risky than using equity financing. On the other hand, a lower ratio suggests that a company is relying more on equity financing, which is generally considered less risky. Lastly, gearing ratio is a financial ratio that measures the degree to which a company's operations are financed through debt or preference compared to equity. Compared to equity. That was the last ratio. Thank you so much for watching, and please note all these ratios and what I have written. This will definitely help you for your exam or for understanding the ratios. So please copy it from the video while pausing the video. Thank you so much for watching till the end. And I have also included, we have discussed about the liquidity ratio uh, in the first video, so you can also check it out. Thank you so much. Have a good day. Thank you.